This week I'm just going to jump right into our first screen for rates, and then I'll follow it up with beta. Over the next few months, you'll see the market outlook change. The first big move is that it's going to shrink considerably, and the longer version will be put on the mm.com site, which is free. You can get a free account on markmeldrum.com. And you'll get the full level 1 CFA from 2018. So if you've ever been curious as to what is covered in the CFA program, at least back in 2018, it'll sort of give you a good idea. And if you want to educate yourself to a level 1 standard, it'll be there for you. But the market outlook will be there. The hope is if I bring you into there, along with all of the 2018 CFA material, you will take an advantage to go through some of that. So I'll just start. The first two screens will be what the market outlook will be once we get to about May or June, and then we'll see what I have added on. That will be available on the site. So if you have a free account on markmeldrum.com, by about mid-May, the whole market outlook will show up there. It's not as if you got to watch half on YouTube, then go to the site to watch the other half. The whole thing will just be there. So let's just jump right in. If you had, just come back Friday after the close and said, well, where are rates compared to last Friday? And I showed you this, you would have said, nothing much happened. Look at this 0, 0 over here, 0, 0. And where there were movements, 1 basis point, 1 basis point, 2, 2, 1, 2, 3, 5, nothing going on. But man, was there volatility last week. So right here, 462, that is the 10-year on Wednesday. So last Friday ended at 4.49. By Wednesday, you were at 4.62, only to come back down to 4.47 on Friday. So anyone who's in TLT, what a roller coaster ride. It was a big negative reaction to the CPI. And then a big positive reaction to the PPI, even though the PPI confirmed the direction of CPI. It is not the PPI or CPI that the Fed pays attention to, it's the PCE. So I thought this week would be a good week to explain why the potential or the promise for PCE is to come in below expectations. Look at the 30-year. 4.69 went to 4.83, back to 4.69. A full round trip, looking like nothing happened. But if you were on the long end of the curve, you got whipsawed over the course of the week. The slopes, almost no changes on any of the slopes. The 3-month to 10-year lost a basis point, now only upward sloping by 13 basis points. Could we get a double inversion on the money market, the capital market curve? FOMC, 31 days away. We're getting a new summary of economic projections with this one, so that's going to be interesting to see. I think this is the right bet right here. Almost 100%, 97.5% on nothing happening. I think that's the right bet. Probably nothing happening, but we do have a jobs report coming up. And that jobs report, especially with all these government layoffs that are happening now, has the potential to come in maybe even negative, because there are going to be job losses in the government sector. You're hearing about this department, 2,000 here, 5,000 there, 10,000 there, 3,000 here. There's some big numbers being thrown out, a potential of up to 200,000 that were in the crosshairs. What's that going to look like? And is that going to cause businesses to hold back a little bit because of this? Well, maybe you get tariffs on April 2nd. So are some manufacturing companies going to say, let's just hold here for a second? You have big return to office mandates that are just flooding across America. Is that going to cause a bunch of quits? So I think the jobs report is going to be an interesting one to see. I think initial claims going forward are going to be interesting, but more on that later. Right now, I think this is, from where we stand right now, this looks like the right bet. Canadian CPI, we get in 2 days. FOMC minutes, we get in 3 days. And being that that they made no move last time, I'm interested in seeing what they say about the balance sheet, because when we look at the reverse repo down here, I think this is going to become a big lead story. either this week or next week it's going to hit zero, and that's going to be, if you're listening to Bloomberg or CNBC, I'm sure a whole day of nothing but talking about that, because of course they like to beat a topic to death when they certainly get a hold of one. And if you follow Japan CPI in 4 days, reverse repo, this is the lowest since the peak of 2.2 trillion a couple years ago, 58.77 billion. So year over year, you're down some 500 billion on this. Reserve still sitting at 3.2 trillion. You're looking at about 20 months of runoff. But as soon as this hits zero, then these start dropping. Reserves start dropping at about the same speed that the reverse repo has been dropping. It'll pull these reserves out of the system into the money market. So that's why it's critical to watch, because the Fed operates in what's called an ample reserves regime. Well, how much is ample? Sounds like, okay, that sounds like a lot, but how much is actually ample? So that you don't have to engage in open market operations at the same time you target an interest rate. You simply target an interest rate. Well, we're going to find out. They don't even know where it is, but they're going to want to approach it slowly. So I think balance sheet runoff is going to become a topic. And the reverse repo hitting zero, I think, is going to be making news. 58.77 billion. We got some Fed speak next week. Harker, Bowman, Waller on Monday. Daly and Barr on Tuesday. Jefferson on Wednesday and Friday. Barr and Kugler on Thursday. Monday, by the way, is a holiday. The markets are closed on both sides of the border. They're closed on the U.S. side and the Canadian side. Let's look at Fed funds futures. They had a big round trip over the course of the week as well. Q1 pricing in nothing, as we see up here. This is the last meeting in Q1, is the March meeting. Pricing in nothing. We call it zero. Q2, maybe half a point there. Q3, there's some uncertainty, maybe something there. And Q4, maybe something there. So there's three maybes in there, which add them all up, you get 40 basis points. So out of the three maybes, it's looking like 1.5 roughly in 7 meetings. TLT, week over week, pretty much unchanged, negative 0.13. And SPX up 1.47. Moving over to the S&P 500, our proxy for beta. Another all-time high. That happened on February 13th, 609.65, and on February 14th, finished at 609.52. No appetite to bring it up 14 cents to hit another all-time high. Intraday, you did hit a new all-time intraday high, but technical analysts will tell you it's only the close that matters. It's only the close. So we do not have a new all-time high on the closing price, but we are 13 cents below a tie. We won't know now till Tuesday. As I do this, Bitcoin is down roughly about $800. It has been a fairly reliable proxy for risk, which means if futures were trading, we'd expect to see them negative as well. Forward 4-quarter operating earnings showing a bit of a drop, 271.24 down to 270.46. The index increased to 61.14, so your forward multiple pushing up against 23 again, 22.6, up from 22.16 on lower volatility as well. Nothing to see here, folks. 22 times forward earnings, push it higher. Less risk involved in higher prices, because why not? Trump, threatening tariffs, threatening border expansionism, looking to make a deal with Russia almost unilaterally against Ukraine, and nothing to see here, folks. Nothing at all. Just keep on walking straight. Don't mind the burning building to the left. 28% percentile, down from 62. That is a big drop week over week. Even in TLT, 46% down to 26%. So nothing to see here. Looking at where the last reading on IV stood for SPY, 11.2 below TLT at 13.1, but both of them down from the week before. Open interest increasing though from 2.51 to 2.58, 258 put contracts for every 100 calls, and for TLT, 48 puts for every 100 calls. Small caps did not do anything near an all-time high, lagging significantly. Large caps just keep knocking it out. IWM, the highest was 241.99 November 29. That's not the all-time high. That was just the most recent high, 241.99 on November 29, 225.97. Week over week up 0.16. Remember, SPX was up 1.47. This squeaked out a 0.16. IJR basically flat, down 0.085%. That's call that zero. 117.09. Small caps just not coming along for any of this. So IWM is still 6.6% off its most recent high. This, we'll call it a cycle high, and this was an all-time high on IJR, down 7.61% there. I think that pattern continues for a while of small cap underperformance to large cap outperformance. LSEG reporting 43 companies reporting next week. SectorSpider.com 45, and I thought, okay, well then Sector Spider, maybe they listed 2 companies with dual shares and they listed both shares. Maybe it's 43, but no, it's not. I got excited thinking, no way, a number this big, and they both got it right, but they didn't. But I tell you, the error between them, the difference between them is getting smaller. Maybe somebody somewhere is listening to what I'm saying and say, you know what, he's got a point, that if we can't get this right, why would they ever give us money for the really important stuff? If we can't get the most objective, simple stuff right, why would anyone give us money? I don't know. Let's look at Sector Spider, see who's reporting next week. Not a lot of excitement in the names this week. The big headline names have already reported. We have Occidental in here. This is on Tuesday, expecting 68 cents per share. Warren Buffett now is just under 30% holding. We did see that he had reduced positions in a number of companies, but not in this one. Still sitting under $50 a share on this one. Let's go into Wednesday. Again, as you look down here, none of the they're all they're all large companies, of course, they're S&P 500, but none of the big headline names, nothing you think that is going to move the market. I was surprised with this one, Garmin. I didn't think it would still be in the S&P 500, and I honestly didn't even think it would still be around. I mean, does anyone use a GPS device? I know they have other divisions. They have marine, they have airline, but their big division, when they were really hitting it big, it was the GPS devices that you would buy for your vehicle, and even in-vehicle devices. But I mean, I just use my smartphone, my iPhone with Waze, and it works wonderfully. I wouldn't even consider a GPS device, but there they are. Garmin expected to report 205, so they must be doing something, right? Let's go to Thursday here. Newmont. For the gold miners, with gold over 2,900 or sitting at the $2,900 range, looking like 3,000 is going to be a possibility. They must have had a good quarter, and their guidance must be good, unless they can't manage their costs. That's the risk with the mining companies. Is it's not just the price of gold; they have a whole cost structure, and you naturally think that they have operating leverage, because if the price of gold goes up, their costs don't go up, so they do even better on their bottom line. The growth on their bottom line is better than the growth on the top line because of the operating leverage and the financial leverage, but it just hasn't worked out that way. Expecting $1.08. And again, looking down here, most of the headline companies are gone. Walmart, their guidance is going to be super interesting. Because there is a lot of anti-American consumer pushback because of these tariffs, and Walmart is got a footprint, that extends outside the United States, and I know what's happening in Canada. There is pushback against buying almost anything American. The Globe and Mail, which is sort of like Canada's version of the Wall Street Journal, had a story where they went into Costco to see what people were buying. Now, Costco's an American store, but they do stock Canadian goods. And as they were going through interviewing people, they were noticing that almost everyone was paying attention to the where the product was made and trying their best to avoid anything made in the USA. So I think their guidance is going to be interesting. What do they say about tariffs and the threat of tariffs? I'm certainly going to be listening to that, because they have to already have been experiencing something, because I know it's a thing in Canada. Pool Corporation at the bottom there, and what do we have on Friday? Another 5 on Friday, but again, it's Constellation should be interesting, but the big headline names are gone. The big one that everyone is waiting for now, the one that usually reports last, you know who it is, right? It's Nvidia. I think they're in 2 weeks before they report. Okay, up to this point, what you've seen for the market outlook is by the time we get to May or June, that is what you'll see on YouTube. Is just those first 2 screens, discussion about where we are for the duration factor and where we are for the beta factor. And then everything that follows, this will be on markmeldrum.com. But again, it's free. You can show up there. I'm trying to push you into an area where you have right beside you as you're watching this video, right on your menu, you can see all of the categories for CFA level 1. Maybe some of you might want to take a walk through some of them, right? So that's why I want to push you over to there. Let's have a look at our CPI. Look at this chart, and you can see from last January, you had this nice move all the way down, and then this move right back up, back to 0.5. If you would have looked at it for the previous year, you would have seen sort of the same pattern. What is going on in here? The BLS updated its seasonal adjustment. Every January it does that, and then it restates the indexes for up to 5 years looking back. So the month over month is meaningless, because this 0.5 is based on the adjusted indexes that you have for January looking back. So the only thing that matters is the year over year. You can't calculate a month over month until you get to February, because then February will be over January, which is restated. But December is not. The December sitting over here. So it overstates. It tends to overstate the CPI index at the beginning of the year, but it suppresses it in the following months like this. And I will show you on an Excel spreadsheet how it would tend to do that. If we look at year over year, because that's really the only thing that we can look at right now, headline was 3%, core was 3.3%, so a little bit elevated. Looking at some of the sub-indexes, super core, and this is where the difference between month over month and year over year matter, especially for January. The month over month is meaningless, came in at 0.494 on super core, 6.1% annualized. Year over year, 2.36 on super core. That's the more important number that we're going to look at, 2.36. Services, just the service category, less shelter, 0.517 month over month, which is 6.4 annualized, but it's only 3.94. Looking over to PPI, this is final demand for goods, and I've explained this before, and I keep hearing it said the wrong thing, is that CPI measures price inflation for consumers, and this measures price inflation for producers, not the final demand. There are the 4 levels that you can look at that do, or the stages that do measure the cost inflation as inputs to producers. This is what producers receive. This is what consumers pay. So it's just the other side of the coin. So CPI, the goods minus food minus energy, because this is what we're looking at here to compare it with final demand for goods. It was 0.3. If you took goods minus food minus energy in CPI, this is what the consumer pays for. From PPI, 0.1, what the producer gets paid. 0.1, if you take out as the total, that's scary, right? 0.6, but food and energy, those are the big deals in the US is food and energy prices. Now you got to pay for that. So that's why the Fed looks at headline PCE, because it does include food and energy. But when you take out the volatile components, because these can move for reasons other than increased demand, 0.1. And if we look at final demand for services, and we'll keep trade in there, is 0.3. In the CPI, it was 0.5. So it is lower. Year over year is quite high. The change 12 months, 3.5. This is less food, less energy, and trade. Trade is the profit margin, up 3.4%. What was positive when this came out is the factors that flow to PCE came in lower. Why didn't we look at CPI for that? Because you have some of those elements in CPI. Why was PPI more important for that? The CPI survey is based on a household survey. The PCE is based on a business survey. The PPI is based on what businesses receive. So the PPI is closer to CPI in terms of the sampling that's done than CPI, which is why the PPI had more importance. And I'll give you an example of one category in particular that is in the PCE that's not caught in the CPI, but that has a higher weighting in the PCE than in PPI, and it came in at 0. So we'll look at the Cleveland Fed's nowcasting to see what they're thinking PCE will be. I also want to take a moment to correct some language from Trump, because every time he says it, I cringe and I say, you're saying it wrong. When he talks about reciprocal tariffs, he's saying, if they charge us, we're going to charge them. That's not how tariffs work. Tariffs are a tax on something coming into the country, not on something leaving the country. If these were export duties, then that statement would be right. But these are tariffs, which are import duties. So just to correct him, here's the proper way to say it. Now, when he says this, if they charge us, we're going to charge them. And if you know nothing about tariffs or you're not that well informed, you might say, yeah, that's fair. You charge us, we'll charge you. The proper way to say it is this: if they are going to charge their citizens more, we are going to charge our citizens more. When it comes to tariffs, that's the proper way to say it. If India is going to charge their citizens more to buy cars, we're going to charge our citizens more to buy cars. If they're going to punch themselves in the face, we're going to punch ourselves in the face. We're not going to let that go unanswered. If they're going to shoot themselves in the foot, we're going to shoot ourselves in the foot. How dare they, right? You got to say it right. Now, when you say it this way, you would say, hang on a minute. Wait a minute, though. Why would we do that? Exactly. Why would you do that? The pushback on this might be, hang on a second, though. If you put tariffs on another country, it's not necessarily true that the American consumer will pay, because the exporting company importing into the U.S. would lower their price to keep business. Okay, we can think about that. And let me tell you the experience of that, because Costa Rica has this problem. And you wouldn't know this problem unless you lived in one of these countries that had these kind of import barriers. 30% duty on everything coming into the country, 100% on vehicles coming into the country. So in my home in Costa Rica, I had to buy a new washer and dryer, so I'm looking on Amazon for washers and dryers, and I find a nice model, and I send it to my contact in Costa Rica. I say, okay, here's the one I want. So they went to the store to buy the Maytag with those particular models, and there's different model numbers in Costa Rica because it's a different market. It doesn't have the same model numbers as the U.S. have, and you think, okay, well, that just reflects the country. No, it does not. Because of the import duty, to keep the prices lower, to make sure that the price for the consumer is low enough, Even though it's the same model, even though it's the same thing, you get a slightly less lengthy warranty. The warranty was shorter than it was in the US. And the motor that spins it is a lower horsepower motor. So you get less equipment for the same price. That's what importers will do. If there's no tariff coming in, here's the model you get. Now there's a tariff coming in of 25%. Okay, well, we'll work around that. You will get less. They will lower their price, but you will also get less. Or you'll get a smaller package. So in the end, you get shrinkflation. Either shrinkflation in the quantity of what you're buying or shrinkflation in the quality of what you're buying. But we see that in Costa Rica. Even though it's the same washing machine that you can get out of Amazon in the US, if you buy it in Costa Rica, it has a shorter warranty and it's not as high quality. It doesn't have the same features as the one in the US, and a slightly smaller capacity. So you think, well, I could just order from Florida and have it imported into Costa Rica. You can do that. You lose the warranty, because if you need warranty repair in Costa Rica, they look at the model number, they say that's not a Costa Rican model. So we're not going to honor the warranty. You lose the warranty. So manufacturers aren't just going to take it. They're going to work around it. So if we're going to say a statement, let's make sure we try to say it as correctly as possible. If they are going to charge their citizens more, we are going to charge our citizens more. Okay, this looks like a busy screen, but I'm going to walk you through it line by line so you know exactly what you're looking at. Right across the top, you have January all the way through December. The red months are months that have an FOMC meeting. We have March, May, June, July, September, October, and December. So there are your 7 meetings left for the end of the year. January is in the books. 2024, these numbers across the top, that is the consumer price index for each month. That is in the history books, and so is 2025. January 2025 is in the history books now. What we don't have is February onwards. So what I did, because the headline came in at 3%, we'll just put 3% up here, and the core came in at 3.3%. And I said, well, what if it walks down 10 basis points a month? What if we drop from 3 to 2.9 to 2.8 to 2.7 to 2.6, all the way to 1.9 by the end of the year? Is that doable? What would that create on the month over month? And I could look at the month over month and I can say, well, does that match the pattern we saw last year? Is it really out of the realm of possibility that we could do this? So I did that, 2.9, 2.8. So you take 3.311022, which is last February's, and you increase it by 2.9%, you get 320.042, and you take March, you increase it by 2.8, April 2.7, you get what I'm doing, right? So here is the forecasted index. January, because January is in the history books, you just bring it down to this row. All of these are forecasts. Then I calculate the month over month to see if it's realistic. So March, mid-March, when we get February CPI, if it's up 0.3 month over month, that is consistent with 2.9% headline inflation. If you go into mid-April and you get the March CPI, if it's up 0.251, that's consistent with 2.8. And I rounded it off because this is what we would see when we get the CPI report. 0.3, 0.3, 0.2, look at that, negative 0.1, negative 0.1, 0, 0.1, 0.1, 0.1, 0.2, 0.3. Look how it increases at the end of the year. It's high at the beginning of the year, low in the middle, increases at the end. And what I'm doing is I'm still walking it down. 2.1 to 2 to 1.9, but you still have this increase, even though I'm walking headline inflation down because of the seasonal effects, doing the month over month. Here's 2024, just to see if these numbers here are realistic. Can we expect that? Well, look at what happened in 2024. That's just using, so where do I get the 0.396? It's 311.022 divided by 309.794 minus 1. It's 0.396, but it would have been reported as 0.4. This is last year, 0.4, 0.3, 0.3, 0, 0, 0.1, 0.2, 0.2, 0.2, 0.3, 0.4. up at the end of the year, down at the beginning, into the middle, right? So you're getting this in the middle, but you're getting that kind of effect in 2024, and that's kind of what I'm forecasting in 2025 if I walk it down by 10 basis points a month. That's not keeping it constant. If I kept it constant, you would say, well, you're keeping it constant, it should reflect what last year looked like, but I'm walking it down and I still have the same look. So down here is the core, and I have these in blue. This is where I feel the Fed has windows to cut. The earliest cut, I think, would come in June if, in fact, we can walk it down 10 basis points and you get a 0.3, 0.3, 0.2, negative 0.1, and negative 0.1. Well, we're not going to know this until July, but we would know the negative 0.1. I'm thinking along with the change in employment, this would be the earliest opportunity to cut. I see 5 windows to cut. I'm thinking at least 3 of them are cuts, which is why I'm at minimum of 3, assuming nothing really breaks, a minimum of 3 to 5 cuts for the year by slowly walking this down, which I think is not out of the realm of possibility because the patterns match. Let's go to core 3.3, and what I've done is I've walked it down 10 basis points as well, 3.2, 3.1, 3, and forecasted where the index would be. So 318 year over year, 2.8 on the core would put it to 327 month over month. That is actually, well, negative. It's negative there, but we call it 0 because the CPI would round it off. Now this is CPI. PCE typically comes in lower. So what do we have here? 0.3, 0.3, 2, 0, 0, 0.4, negative, 0.2, 0.2, 0.2, 0.1. What was last year? Just to see if it's realistic. 0.4 versus 0.3, 0.4 versus 0.3, 0.3, 0.1, 0.1, 0.5, 0, 0.3. Almost the same pattern. 0.3, 0.3, 0.2. So yeah, I think even assuming that it only comes down 10 basis points a month. Now you can recreate this. This is easy to do in Excel. And then you could put in your own number. So next month, when we get CPI, when we get the index, I can simply just add a number here and change this to the actual, and all of this will change on its own to see whether or not it is still doable, whether or not I still get 3 to 5 rate cuts. So if it comes in below 320.042, I feel more certain that we're probably closer to 5 rate cuts than 3. If it comes in a little bit higher, well then maybe it's 3 to 4. If the next month comes in a little higher, well maybe it's 2 to 3. And by mid-year, I'll have a fairly good idea of how I feel on my ZQ long futures by just updating this every single month. So I will just wait till next month till we get the number. I will update both of these and we'll see what happens with these. For the Fed itself, I've got May. I don't think we'll hear much in March about balance sheet runoff and rebalancing. Maybe a small conversation about balance sheet runoff, but I don't think rebalancing will there. But by May, I think you'll probably have some kind of conversation about when they expect to put in a slowing down of balance sheet runoff, maybe even stop it, because I think sometime this week or next week that reverse repo hits 0. And possible rebalancing, which means selling off MBS and buying U.S. Treasury, which would be a support for U.S. Treasuries. Okay, this is from the Cleveland Fed. If you Google search for inflation nowcasting, you'll get a link for Cleveland Fed. Here's what you'll see. This was updated on February the 14th. This is for PCE, particularly what we're looking for. The first panel is month over month. The second panel is year over year. This is their expectation, 0.18 on headline PCE, which annualized comes to about 2.2%, which is what the target, the Fed targets the headline PCE. Core 0.22. Look at what it was the month before, January 0.38. If you get that drop down to 0.18, that is a big drop down. I think that makes the Fed happy. We're going to get that at the end of the month, so that might reflect through to the SEP. And if you get a weak jobs report On top of that, you might get 3 to 4 rate cuts penciled in on the SEP. They might be a little bit more willing to lean on the full employment side. 0.37 on core, down to 0.22. Again, yeah, let's keep in mind these are forecasts. These are not in the history books. This is all history right here, but these are forecasts. Looking at the year-over-year change, 2.51 was the January read, expecting 2.38 for the February reading, working its way towards 2, down from 2.51. And the core, 2.66, 2.64, nothing really much there, but they are targeting the headline, and it is moving in the right direction. I'm going to quickly throw January retail sales in here. This is January 2025 from December. This is the month over month, and here is the year over year. This is the column that we're particularly interested in. I was going down. I was going to highlight where everything is negative, and it got tiring, and I thought it's easier if I just highlight what was positive. Grocery stores, month over month up 0.2. Gasoline stations up 0.9. Two things that you really don't want to see, right? You want to see those negatives. So right away, that's, as far as the consumer goes, that's not really a positive. General merchandise stores, 0.5. Department stores were 0.8. Miscellaneous stores, 0.2. And food, services, and drinking places, 0.9. Everything else was negative. The total, negative 0.9. Excluding motor vehicles and parts, negative 0.4. Excluding gasoline stations, negative 0.1. Excluding motor vehicles and parts and gasoline stations, negative 0.5. Retail, down 1.2. Motor vehicles and parts, down 2.8. Furniture and home stores, down 1.7. Electronics and appliance, down 0.7. Building and material, down 1.3. Beverage, food and beverage stores, down 0.1. Health and personal care stores, down 0.3. Health and personal care, down 0.3. What's going on over there, you guys? Clothing and clothing accessories, down 1.2. You're not showering as much. You're not dressing as well. What's going on, people? Looking at the year over year, your big drops here are sporting goods, hobby, musical, negative 4.1, and general merchandise stores, the department stores, negative 1.4. But there is no sugarcoating January. That was not a good retail sales report at all. All right, let's walk through how I'm thinking about equity exposure in the U.S. Or beta exposure, and how I'm thinking about interest rate exposure in the U.S. or duration. And I'm not considering the Fed here. I'm not sure that the Fed is going to be much influence going forward. As they were raising rates, markets kept hitting new highs. The economy kept performing. So I don't know if raising rates didn't hurt the economy. Is lowering rates really going to be the big boost that everyone's waiting for? I'm not sold on that. I think that's more critical for duration, the Fed. But I think for equity performance, it is the fiscal. So thinking about tariffs, actual tariffs versus threats only. If they're threats only, what is the fallout? If they're actual, what is the fallout? And I put probabilities, not numbers, but whether it's high or low. If you get actual tariffs, retaliation, I put a very high probability on that. Canada, Mexico, the European Union, all will hit with retaliatory tariffs. And downstream job losses, I put a high probability there. So if you do have tariffs on steel and aluminum, U.S.-based steel and aluminum companies will be able to raise their price, but downstream you'll get job losses. We already have a case study for that, which was the last time Trump did that. And the retaliatory tariffs, the money that was raised had to go to the farmers because China retaliated by raising import duties or putting tariffs on farm product coming out of the U.S. So any money raised simply just went to pay the farmers for what they were losing. It was just a loss across the board. So because there'll be a high probability of retaliation, and because there'll probably be a high probability of downstream job losses, I forecast lower growth. There'll be import substitution to domestic goods because coming in will face a tariff. So, okay, let's not import, let's switch to domestic goods. That supports the price. So we see that if you look at COMEX and you look at the aluminum contract, it really went up. Even though the tariffs aren't there, prices are starting to increase in anticipation of the tariffs. You don't actually need a price increase to get an increase in prices. You only need the anticipation of a price increase for prices to start increasing. Just the expectation that something will happen will start to increase prices. So you're already starting to see tariff inflation in steel and aluminum, even without tariffs. It's only the expectation. And if you have to import to domestic goods, the price will go up. And that's why I say there'll be some downstream job losses, because the most obvious thing for other countries to retaliate against are the finished products. You want all the washing machines and dryers made in the US, no tariffs on the steel that go into that. Well, now you want to export that to other countries. Now there's going to be a duty on the washers and dryers. So we'll just target something more downstream. Export substitution to the domestic market. If you have retaliation, you're going to get lower demand. We're already seeing it in Tennessee and in California coming out of Canada. The reduction in ordering, the switch in Canada, the patriotism that's arisen in Canada to buying anything but US is showing up. Switching from California wines to Niagara region wines or BC wines or Italian wines, foregoing the Tennessee alcohol for the Canadian alcohol from Seagram's. So you get this export substitution to the domestic market. Well, if the domestic market was exporting, so with all the Jack Daniels that would have been exported, now it's available within the borders of the US. So now you have an oversupply of something that otherwise would have had an export market. That will lead to either price decreases or job losses. So if you do get actual tariffs, you will get retaliation. There will be downstream job losses. I can only get to lower growth. I can't see how you continually grow in the face of that. What if they're threats only? You are already getting reverse nationalism. Here is the danger with consumer habits. Is once a consumer makes a change, it's very hard to get them to change back to something else. So brands know this, especially brands for consumption product, where it's something that you buy all the time, something you consume. If there's a stock out and consumers are forced to use another brand for a period of time, it's very hard to get them to switch back to your brand. So you're already seeing, and I say reverse nationalism, as opposed to America first, America last. In the grocery stores and in the malls, there is, among Canadians, I can tell you this because I've been out there, I've seen it. There is a push to see, well, where is it made? Anywhere is okay but the U.S. If it's made in the U.S., don't want it. So they're already getting a drop in aggregate demand for American goods. If they're threats only and you keep threatening, you will get isolationism. Canada is got a trade agreement with Europe, where I think 98% of the items we trade have no tariffs on it. So we do have CETA. CETA can be opened up to include a lot more things. The Canada and the European Union have met to discuss how they can, trade with each other more often rather than trading with the U.S. You poke your finger in Canada's chest. You poke your finger in Mexico's chest. You poke your finger in India's chest. You poke your finger in China's chest. You poke your finger in Europe's chest. You can't open a trade war on 5 fronts. You're going to get hurt very badly. Now, other countries are going to get hurt. But there's 8 billion people on this planet and only 350 million of them are in the US. They don't have to be there. The idea that if you make your stuff in the US, there won't be any tariffs. Well, I mean, obviously. But that's a big commitment. Billions of dollars for what? Maybe 2 years? Maybe 4 years, 2 years until the midterms, maybe 4 years until maybe you get a change in regime and suddenly those tariffs are gone. Now you have overcapacity in the US market. I think most companies in most countries will make do what they can for the next 4 years. You run the risk of isolationism and this reverse nationalism, which we are seeing in Canada. All of this, poking your finger in everyone's chest, telling them you don't measure up, you don't measure up, do what I say or else, do what I say or else, creates a common enemy. This may be his legacy, is not make America great again, but make the world great again by relying less on the US. What it has done in Canada is it's opened up a serious discussion about removing interprovincial trade barriers. We can't trade some things between provinces, which seems rather stupid. But if it's done anything, if Canada can look to the US and thank Trump for something, it's like, hey, thank you for this because now you've made this a necessity. Before it wasn't a necessity, now it is a necessity. So it is a catalyst for alternatives, not surrender. It's not as if Canada's going to say, oh, what choice have we got? We got lots of choices. We got a whole bunch of countries that we can trade with. Almost every country in the world that has nuclear facilities wants our uranium. We only sell it to the US because it's convenient. You're right there. So here you go. But we can sell that anywhere in the world we want. We send our oil to the US because it's convenient. But we can easily transport it, build a pipeline from where it's taken out of the ground to where it's refined on the East Coast without much of a problem. It would create investment in Canada. And since capital goes to where it's going to receive the best risk-adjusted return, if there's more investment and growth to be had in other countries by doing this kind of thing, removing interprovincial barriers, we will draw capital out of the US. So that is the risk of walking around threatening a bunch of people, is that you unite them against you. Right? If you're going to open up a war, open it up on one front, win that war, and be stronger. Then open up another front and win that war. Then open up, but to threaten everybody and then to have your vice president go over to Europe and lecture everybody. No one likes to be lectured. This threat only is still causing a problem for U.S. exports because I am sure in other countries, I think I read something that in Europe they're already looking at, consumers are already concerned, is this from America? I don't want it. In Canada, it's a very real thing. You've awoken Canadian nationalism, which Trudeau has done his best to beat it out of everybody, that we should not be proud to be Canadians. He's had 8 years to piss all over Canada and tell us how bad we are and how dare we be proud in being Canadian. We're terrible, we're awful. It has reawoken that the maple leaf is meaning something again. And I know that probably doesn't mean much to somebody who's listening who's a Trump fan, but understand that it means less American demand. One of our airlines, I believe it is, I think it was Air Transat, I forget, one of our airlines reported a 25% drop in flights going to the US. So that is money that is not landing in the US. That is an airport, that is a plane that won't land in the US. That is an airport fee that won't be charged. That is how many cab rides or Uber rides from the airport to the hotel. That is how many hotel rooms, how many room service fees, how many restaurant meals that won't be eaten, that won't be ordered. So at the margin, it is already lowering demand. That's one country. So you have to be careful how many people you threaten. Now, if it is threats only, that's not going to work out well, because Canada's already saying, why threaten us? Why threaten us? It is creating a lot of distrust as well, is that, when you look at Putin, you say, well, you can't trust him in any deal. When you look at Xi, it's like, well, but you can't trust him either. But the world is also saying that to Trump. Trump will throw a deal away the moment he decides it's not working for him. Even if he negotiates it, you can't trust him the next day. So you have this alignment of Trump and Putin and Xi that want to meet and talk about reducing the amount of military spending. Why do we have to spend so much on military? Well, you can't trust Putin in that deal. Well, you can't trust Xi in that deal. And both of them know you can't trust Trump in that deal. So three people who you can't trust getting together to sign a deal. Hey, that's going to be a good one to see. But this is a problem. What about U.S. expansion going on? I put a very low probability on that. I put it basically as zero. Beyond renaming bodies of water, I don't see the U.S. borders expanding at all. Just the threat of saying Canada will become a state, we'll invade Panama, we're going to take the canal back, we want Greenland, we're just going to take Gaza. Again, you're opening up how many fronts, right? You got your trade war front, now you have your geopolitical fronts. You're creating a common enemy that will unify others against the U.S. So in a way, Trump could bring peace to the Middle East. By the Arab states unifying, saying, you know, we don't really get along all the time, but this one here is not going to happen. No way is America going to get a toehold in Palestine, and Trump's not taking it. No, it's not going to happen. It is just unifying everyone against the U.S. That is the risk. Trump, in the end, in the model that I have of him, he is not dangerous to the world. You hear some comparisons to Hitler. He's not a Hitler. He's not dangerous to the world. He's only dangerous to the U.S. I think Trump wants to be expansionist. I think he really wants to be remembered as a president who expanded the borders of the U.S. But he's not going to fight for it. If he can rename something, he'll rename something, but he's not going to fight for it. In this respect, he is not a Caesar. Even though he wants to be, he's not a Caesar. He's not an Alexander. He's not a Napoleon. In the modern day era, he's not even a Putin or a Hitler, because he lacks two qualities that conquerors, and I'm going to call them conquerors, usually have. Number one is courage. You have to have the courage to invade a country with your military unprovoked. Putin has the courage to invade another country. Hitler did. He walked all over Europe. He invaded country after country. I'm only comparing it on the expansionist side. I'm not comparing Trump to Hitler on any other point other than expansionism. Hitler had a European manifest destiny. Trump has this North American manifest destiny. He will not use the military to invade another country unprovoked. He lacks that. The other thing he lacks is a level of intelligence. I don't know that he's smart enough to play that kind of global chess game. So I see him as not being dangerous to the world. All of this talk about, oh, he's upsetting the world order, he's a danger to the world. No, he's not a danger to the world. I think he's only dangerous to the U.S. itself. In the end, I cannot be positive U.S. equities. Even if I give a low probability to U.S. expansionism, I believe that his tariffs are really threats only. It's not going to do much. What he has done is awoken the nationalism and pride that other citizens have for their own country, where they're reminded that, you know what, we should support our own country. America last. America last. Hard to be positive on beta for that one. So I have increased my short position going into last week on IWM. I'm not going to short S&P 500, but the small caps, I think I'll continue to short them. But I did increase my short position. I sold a whole bunch of $230 calls on IWM. Let's go on to duration. And what do we expect here? Here we can shift back to the Fed. Maybe a little bit of fiscal policy in here, because Besant does want rates to come down, meaning the yield curve to drop, not necessarily the Fed dropping rates, but the yield curve to drop. Here I do agree with a lot of the things the U.S. government is doing. I think the job cuts are appropriate. I think government has gotten way too big. I think the examination of government spending line by line is absolutely critical. We have this problem in Canada. The business I had in Canada, the amount of taxes that we remitted on a monthly basis in terms of the GST, in terms of payroll tax, in terms of income tax that you got to pay in advance, and you can't balance the budget? You got to be kidding me. When you think about how much taxes are in just housing, 30% of the cost of a house is a tax of some sort. Development taxes, land transfer taxes, 30%. And you can't balance a budget? Spent over $1 billion on a stupid app, ArriveCan, and it still didn't. $1 billion for an app. You got to be kidding me. So, you know, if you went line item by line item through Canada's budget, I'm sure you'd find the same thing. Now, that is not government spending. That's taxpayer spending. It comes from all of us. When you guys are done, and I say you guys, my American friends, with Elon, if you could send him up here for him to go through our budget line by line by line, I am sure he'll find the same type of ridiculous spending. Right away, $1.5 billion to the CBC, which is really just the Trudeau Power Hour. It's just amazingly great coverage of Trudeau for 8 years and just shitting on everything else because they're funded by the Trudeau government. It is state-sponsored television that nobody really cares about because we're tired of being lectured to and indoctrinated. Get rid of that, right? So I agree with that. I agree that government has just gotten way too big and has decided that it wants to be involved in your lives way too much. I perfectly agree with that. But that is going to hit full employment. If you're going to remove that spending, if you're going to shrink the size of government, you will put people out of work. You will separate them from their paychecks. I agree with that, and I think that shrinking of employment is a necessary step to go because we're the ones paying the bill. It's like everyone's having a great meal, and at the end of the meal, I'm the one who gets the bill, and I wasn't even invited to the party. But we all got to pay the bill. I agree with all of that going on. I think that full employment for the Fed will become a bigger deal than price stability. I think the hit to growth over here, I think some prices will go up and some prices will go down. The stuff that was being exported will now be in abundance in the U.S., which will drive prices down. The stuff that was being imported will now be in a shortage, will drive up the domestic version of that. So you'll get some things that are increasing in price, some things that are decreasing in price, but I do think high probability of job losses. I think full employment becomes the bigger deal. They do have a dual mandate. Let's deal with price stability first. We saw the CPI go up. I put a question mark on the PCE because it is still just a forecast, even though we looked at what Cleveland Fed is looking at. It is still just a forecast. So I put a question mark whether we'll see it go up or not. We did have a restating of the CPI and a restating of the indexes for the last 5 years. CPI is based on a household survey. PCE is based on a business survey. It is broader. It covers more categories than the household survey, and it has different weights and different scope, obviously, because it covers more. Household survey is measuring those things that are paid for by the household itself, and the PCE is measuring those things that are received by businesses. So it is broader, because if you have healthcare coverage, you pay health insurance, but health insurance pays everything else. So as far as the business is concerned, it doesn't matter if it came from the household or if it came from an institution like your healthcare service provider or your insurance company that was repairing a vehicle. It counts that in the PCE. So just as an example, because most citizens don't directly pay for their health care, they pay through an intermediary. Let's just look at medical care. The weighting in CPI is 6.7%, and the month over month was zero. No change. month over month. In PCE, this has got a heavier weighting. A heavier weighting towards zero, right? So that's the difference between how some things from CPI or PPI can flow through to PCE. PCE would have a higher weighting, and it tends to have a higher weighting on those things in those two reports that actually came in lower. That's why there's a belief that PCE will come in lower. For full employment, I see this going lower, not higher. In other words, the unemployment rate rising, initial jobless claims beginning to rise, continuing jobless claims continuing to remain elevated, if not go higher. There's this thinking that you have tax cuts. You have the Trump 1.0 tax cuts that expire at the end of this year and looking to extend it. And there's something, well, the tax cuts are positive for growth. Well, not an extension of tax cuts. You'd have to have new tax cuts to be supportive for growth. But 2024 had those tax cuts. 2025 has these tax cuts. If you extend them, then 2026 has the same tax rates. It's just that tax rates won't go any higher. I don't see this as being the next leg up in growth because you're just extending what you already have. Tariffs, or even just the threat of tariffs, I think leads to lower goods demand coming out of the U.S. And for the goods that were imported into the U.S., less will be imported, which will raise the price of the domestic version of those goods. But there will be retaliation, and even if there are no tariffs, you'll still get the goods coming in the country, but other countries will still hold to their anti-American sentiment on their purchase decisions. And once you change consumer behavior, it's brutally hard to change it back, right? This reverse nationalism, drop in aggregate demand, and low population growth because, hey, you're stopping people at the border who were otherwise coming in. When they come in, they buy food, they pay for shelter, they get a phone, they drink beer. Some of them get jobs, they have kids, they have to buy clothes, maybe they got babies, they got to buy diapers, maybe they don't demand as much as a landed American does, but at the margin, it's aggregate demand. Well, by all accounts, the migration across the border has basically dropped to nothing. I mean, it's basically dropped to nothing. I think the last one, I saw a headline when it dropped 90%. Another, just this past week, is basically no one is showing up at the border. Well, that's a drop in aggregate demand, and that was population growth. That is the source of growth. Is population growth because your labor force grows, right? And if you don't have labor force growth, your potential GDP can't grow because you have more people available to work. So lower population growth does lead to lower growth. Lower growth means I don't need as many workers. Think about how many businesses that are within maybe 50 to 100 miles of the Mexican border are saying, restaurants or diners or motels and any of those sorts of businesses where the demand has really just dropped off in the last little while. Well, they've got to either release employees back into the labor force, or some of them probably just shut down and disappear, maybe go out of business, because you have taken a huge amount of aggregate demand out. Now, I agree with the firming of the border. You can't have people just walking across the border. I do agree with that. I'm not negative on that. But you do have to be realistic about the impact it will have. Yes, good step to have, but understand the trade-off is that aggregate demand is now not showing up. That increase in the labor force, even though they're undocumented, that increase in the labor force are now not showing up. So you will get some drop in potential GDP growth. You're already seeing some drop in aggregate demand. This is a drop in aggregate demand. The tax cuts do not provide a boost. So I think the Fed is more than positioned to lower rates. I'm expecting the next jobs report to be rather ugly, because how many layoffs have been announced just in government in this last week? And they haven't even gotten to the other departments yet. There was a long story in Wall Street Journal how other departments are already sacrificing their employees, hoping to avoid deeper cuts somewhere else. They're already sacrificing up the probationary employees. In other words, eliminating them before before Musk and the Doge team get to their line item, in hopes that they can avoid the worst. But they won't. It'll still be line item by line item. This is the ripple effect, right? The multiplier effect. You got a multiplier of 1.8, 1.6 to 1.8 in the U.S. economy. So every $100,000 the government doesn't transfer to somebody, let's just straight call it wages, means 180,000 that disappears from aggregate demand. So it's much more than just the savings. So if you say, well, laying off all these people only save $1 billion, yeah, but it's still $1 billion, and that's 1.8 billion off of aggregate demand when you lay them off. Which means at the margin, some people in some businesses somewhere would lose their job because these people are losing their job. That's the downstream effect, which then takes that multiplier off the market. Once you start down that road, you are going to have a readjustment. And again, this readjustment is necessary. I think it has to happen. Government has simply gotten too big. Government seems to support almost all the growth in the country. So either we are a capitalist country where capital is allocated to its best use, or we are a socialist country where the government provides for everything. Whichever one, let's just get there fast. I seem to think that reversing the trend makes sense. This is why I think the Fed has an opportunity to cut, not in March, but at the next meeting. What did I pencil it in at? I think June. Not March, not May, but June, I put as their first window to cut. I think we will see enough of the jobs report to see that. The layoffs from the government, the layoffs or the lack of hiring, let's just say the lack of hiring from the private sector, just because of the threat of tariffs. Actual tariffs will lead to not just lack of hiring, but actual job cuts. I don't know how you can be positive beta in this environment, and I don't know how you could be negative duration in this environment. So here is my expectation and positioning, because I think there's only really two things that we're concerned about, and that's the dual mandate of the Fed. If we want to know the direction of rates, there is jobs and the price level. Jobs, I expect to see lower numbers, even negative, which is downward pressure on wage inflation. You're seeing a lot in federal employee cuts. I think you'll see more. I believe that's necessary. It is a necessary adjustment. Return to office cuts and quits. I believe that is necessary as well. You have more companies that are demanding a return to office. You had some pretty damaging research by McKinsey the week before, showing how those who work from home tend to work 3.5 hours less per day. They tend to spend more time on leisure and sleeping. Jamie Dimon, I don't know if you heard that leaked audio of what he was saying. A lot of F words in there, dropped a lot of F bombs, but he was right against the whole thing, and this is catching on. Some people are going to quit because of that. I believe that is necessary as well. So these are welcome things, even though it's going to be lower numbers and even negative numbers. As market participants, our job is not really to offer any value judgment on the direction of things, but to position ourselves for that. Watch the initial claims and continuing claims. It'll start showing up here in initial claims. Those who took buyouts, they're getting paid for another 8 months. At least in Canada, this is how it works. If you have a severance for a period of time, you cannot apply for unemployment until that's over. And that would be in your separation papers, which have to be filled out, your record of employment, and then submitted. And in the record of employment, it shows how much longer they're going to be paid. So if there's severance, like 2 months severance, you got to show the 2 months severance. and then they can't apply till after. So this may not show up for 8 months in those that took the buyout, but those that are being laid off, those that are in the probationary period, for those that can't fall into another job and that have been employed long enough to qualify, you're going to see it show up in initial claims. As far as the price level, it's the expectation of inflation that can create inflation. You don't actually have to wait for prices to go up. You can anticipate that prices will go up and prices will go up. So you're already seeing that in the categories that Trump is already threatening tariffs on, is you're already getting higher U.S. prices along with lower aggregate demand. I think price level will be higher initially because of this expectation, then lower on lack of action. When we get to April and we see that they were primarily threats, I'm still on the high probability that these are just threats. I don't know that Trump wants to get into a fight. His history has been to threaten fights and then see what falls out. You know, if you have 100 people in the room, threaten them all. Maybe 80 people will stand firm, but 20 people will cave, and you'll get something more than you had before you threaten them all. And that's sort of been his style. So I place a low probability, when I say low, probably below 40%, maybe even below 30% on tariffs actually happening on Canada, on Mexico, on steel, on aluminum, and on the European Union without very significant carve-outs. But I do see something for India because he does have a point. They do have extremely high tariffs. And China, well, I think he wants something out of China. So until he gets what he wants out of China, I think those tariffs are real and they'll probably stay in place. So I do think lower prices will be lower when we see that there is lack of action. Lower, but in the end, even if this is true, even if there is a lack of action and no tariffs happen, you will end up in the end with lower demand for U.S. goods and services. That is almost certain because you're already seeing it now. Once you force somebody to behave differently, and we're not going to find out for another month, once you change consumer habits for a whole month, they don't just flip back. So this is almost certain that you're going to see lower demand. So I think the price level probably higher initially and then down. And I think jobs probably down, which means interest rates probably down. So my positioning, negative on US beta, more negative on small caps than I am on large cap. I'm negative to neutral on large cap, but I just don't want to short large cap when I have something that is more obvious here. So short small cap beta. For duration in the US, on the short end of the curve, ZQ, which is the Fed funds futures, I think being long the Fed fund futures right now makes sense because they're priced as an index, right? 100 minus R. So as R drops, the index increases. So let's say R is 4%, the index would be 96. If R drops to 3%, the index moves to 97. So long ZQ, I think, makes a lot of sense, simply because I think this will force their hand before price stability does. And capital market duration, this is the longer end of the curve, the 10-year, the 30-year. TLT is a good place to be on the longer end of the curve. I'm in that, and I'm okay with that. It has been volatile, but I think that the long end of the curve will begin to pay off. A negative the U.S. dollar on this one here, because I believe that that we'll see this, a lack of action, at least to the scale that he's threatening. I think you're going to see if there are tariffs, it'll be like 10% of what he's threatening, or I wouldn't say 10% across the board of what he's threatening, but 10% of whatever he's threatening will actually come to pass, whatever it happens to be. If you get a drop in the US dollar, you get a rise in everything that's denominated in US dollars. So copper and gold is how I would be positioning. And that takes us to the end of the market outlook. As I said before, by May, mid-May, end of June, this market outlook will be shortened to just the first two screens. A review of where we are in rates, a review of where we are in our beta, proxy, which is the S&P 500, and then we'll end it there on YouTube. The rest will be on our site, but the whole thing is on our site. So you could just get a free account, and every Sunday when it's posted, you could watch it right there. One more screen to go, and this is for Discord, because the Discord server we're going to start getting people into the server this week. This server, when you say Discord server, it means Discord community. We'll start getting them in this week. Let me show you what the structure looks like. Okay, there it is. I shouldn't have to explain that. Applied Series Plus. The Discord server really was, the motivation was to create a forum where people, subscribers to the Applied Series, can have a more robust and fluid conversation. Our site is set up such that you can have a conversation under each video, but it doesn't lend itself well to talking across multiple topics at the same time. So there are roles. I can set up roles and then permissions. The roles will be A1 to A4, A for applied, and then 1 through 4. A1, these are anybody. That means you don't have a subscription to the applied level, but you watch the market outlook and you want to contribute to the conversation or be part of the conversation, because I will eventually close the comments on YouTube. That will be for the market outlook. And how it works is A1, as far as permissions, anybody can come in. I will have a invite link where you can click on and you can come in. However, you cannot contribute. You cannot comment at all, because if I give a public invite, all the bots come in. And the bots, I'm told, on Discord are worse than what you get on YouTube. You know, on YouTube, who do you use? I use this person. Wow, I'm surprised to see her mentioned here. Where do I find her? She's on Telegram. I'm making 3 Bitcoin a week off her. Like that, you know, that nonsense. Nobody wants that. You don't see that in my comment section, because I delete easily 20 to 30 of those every single day. Every day I delete them. I have a notification every time a comment is on my channel. I get a little notification because I have the app on my iPad. And I can see it. It comes down. I go, I know what that is. And by the time I go to delete it, it's already like 7 comments deep, you know, and you have to delete all of those. I spent a lot of time deleting that. It's just going to mess up the conversation. So when you first come in, just to make sure the bots can't contribute, nobody can. And then it is by invite to contribute. There'll be a text and video channel. What makes this interesting is while you're watching the market outlook on the site, if you have your screen open, you can have watching on the site, you can have Discord going on right here. You can see the conversation happening at that point in time, as opposed to in the YouTube comments where you can read the comments and then you got to refresh to read the comments and you got to refresh. Here it's happening real time, so you can contribute in real time. I think that makes it a lot more powerful. And I can get involved as well while it's going on live. I don't have to wait till Wednesday to answer all the questions. And the nice thing about the video channel, the voice and video channel, is I can actually ask you for clarification on your question, as opposed to saying, okay, I don't understand what this means. I can ask you for clarification and you can just voice it right then and there. I think that's incredible. I like that idea way better than this static, well, semi-static type of comments on YouTube. But it is by invite. But everybody can come in and read the conversation. But to contribute, it will be by invite. There'll be more information on how these invitations work. But it's going to be like boarding a plane, you know, where I want the heavyweights in first. So it'll be anybody with a university degree first to board the plane. Right, and then once that's done, it'll be okay. Now, anybody who's an undergrad, come on in. Until it gets to the point where I say, okay, that's as far as we go, because I can see the conversation deteriorating. I don't know where it's going to deteriorate, but I'm going to go from the most gravitas to the least. Now, wouldn't you like to at least be a fly on the wall for a conversation that is weighted by qualification? I think so. What is A2? A2, there's A2A and A2B. A2A is everybody who is a subscriber to the applied analysis side of the applied series. A2B is everybody who's a subscriber to the applied asset management. Notice that A2 can contribute to the applied analysis and the market outlook. A2B, applied analysis, positions in the market outlook, because positions is part of asset management. If you're A3, that means that you have access to everything. And this is everybody before January 20th, they're A3. They automatically can contribute to everything. If you are part of the applied series, there is no test as to whether you can contribute or not. I don't have to check qualifications. You automatically contribute. And there is one more category called a super invite, which is A4. It's not what you think it might be. The way it sounds, a super invite, it must be a really great group to be. It's not. It's due to the nature of some people's job. They cannot contribute in open forums. So if there is an open forum where everyone can come in and contribute, they cannot say anything. But they can contribute when it's an invite-only forum. So this is what A4 is for. It's due to the nature of the job. They can't contribute in open forums. It is for them to have their conversation among themselves that's why I call it a super invite, because it is for people who can only contribute if where they're contributing is by invite only. So that's not going to affect, I think on the YouTube channel, it's probably not going to affect very many people. And there we go. It starts next week. We're going to start bringing over the applied series subscribers first. It won't be till about May. I'd say May before we get to the YouTube crowd. And then we'll start bringing them over as well. It's a lot of work, and there's a lot of manual work that has to be done on this, so it is going to take us some time. I'll have more to say as we get closer to May on A1. It sounds like a long time away. We're February now, but really we're talking about 12 weeks, 13 weeks, and it's probably going to take 5 or 6 weeks to get most of the applied series subscribers in and figure out, is there something, are we missing something in all of this? Because we don't want to open it up and find out, oh, it broke. So that is it.